Good afternoon and happy Halloween. Welcome to the Committee for Responsible Federal Budget's webinar on R versus G and the national debt. My name is Chris Rotella, the Senior Director of Development and Events here at the committee, and I wanted to thank all of you for joining us today. A nation's debt dynamics are largely driven by the interest rate it pays on its debt, R, and the growth rate of its economy, G. When interest rates were below the growth rate, the US could run modest primary deficits and still keep the national debt at bay. But with interest rates surging to a 16-year high, the US national debt is on an increasingly unsustainable path. To explain what all this means, it is now my pleasure to introduce our Senior Vice President and Senior Policy Director, Marc Goldwein, who will be presenting to all of you today. At the conclusion of Marc's presentation, he will be taking questions from the audience. So please be sure to submit any questions you have through the Zoom Q&A button. Marc, now over to you.
Thank you all so much for being here today. It's maybe an unhappy coincidence that we're going to talk about something so spooky on Halloween. I know this is a little more of a technical webinar or discussion than we're used to, but I'm very excited to discuss what interest rate and growth rate really means for our national debt. Let me kind of start with some basics, and then I'm going to go into some more details about our debt sustainability. When we're talking about R versus G, and first of all, I really need to credit Olivia Blanchard, the former chief economist of the IMF, for really popularizing this concept, even though it's been a long-known mathematical property. His recent speeches and book really do a deep dive into this issue. And now, when we say R, what we are talking about is the average interest rate on government debt, right? So every year, the government owes money, and the government pays interest on that money it owes. R is the average interest rate it's paying on all of its debt. When we say G, we're talking about the growth rate of the overall economy, typically looked at as the growth rate of gross domestic product, GDP. These variables and others are really important for understanding debt sustainability, which we typically define as debt not growing faster than the economy. But I think an alternative definition would be debt not expected to keep growing faster than the economy. So, for example, if debt is 80% now, and it looks like it's going to go to 100%, but not go above that ever, we might still say that's sustainable, even though debt is rising for a period of time. Debt is unsustainable when it seems like debt is going to indefinitely keep growing relative to the economy. That ultimately leads to ridiculous outcomes like debt being larger than all wealth, or debt being larger than many, many, many times what we could pay back, and that becomes problematic. So there's some cool features related to RNG. Remember, as I said, R is the average interest rate for our debt, and G is the average growth rate of the economy. So another way to think about that is R is telling us how fast our existing stock of debt is growing, right? If I have $100 of debt and there's a 5% interest rate, that means next year I'm going to have 105, and the year after that I'm going to have 110, the year after that I'm going to have 115 point something, and it accumulates and compounds. G, meanwhile, represents how fast the debt is eroding relative to GDP, because each year if the economy grows, our existing debt will shrink as a share of the economy. If we hold our debt constant, but our economy continues to grow, our debt becomes less of a burden over time. This is true if you think of an individual. You know, if you have a mortgage, but your wealth and your income keeps growing, it's less important. And it's certainly true for economies and governments. Now, when the interest rate is below the growth rate, as it has been for most of the last 15 years, debt can be sustainable even if you're running deficits, and even if you're running deficits in excess of your interest. Also, when your interest rate is below your growth rate, one-time borrowing doesn't necessarily have a major effect on long-term GDP. Let me go into a little bit more detail here, and I've tried to create this handy-dandy chart. If you all can commit to memory, that's great, but we'll send this around afterwards. But you really can understand your debt dynamics based on three variables: your interest rate, your growth rate, and your primary balance. If you're running a primary surplus, meaning if your revenue is higher than your non-interest spending, and if your interest rate is below your growth rate, you're made in the shade. You're going to have debt that is declining forever and eventually turning into wealth. On the other hand, if you're running big primary deficits and your interest rate is above your growth rate, you're in big trouble. You're ultimately headed for a debt spiral. Then there's everything in between. The area I want to focus on is this bottom right corner, because this is where we've been living for most of the last 15 years. In fact, all of the last 15 years. In this bottom right corner, you'll see the interest rate is below the growth rate, but we're running primary deficits. And in this situation, so long as everything is stable, your debt is going to max out at some level. And specifically, if your interest rate is below your growth rate, your interest rate is not changing at all, your growth rate is not changing at all, and your primary deficit is not changing at all, whatever it is, your debt is ultimately going to stabilize. And it's going to stabilize based on the equation primary deficit over the difference between your growth rate and your interest rate. I know this is a little bit more math than in these normal webinars, but it's kind of important to understand the concept. Let me give you an example. Remember, your debt is going to stabilize at your primary deficit over your growth rate minus your interest rate. So let's assume that primary deficit is 3% of GDP. Every year, we are spending 3% of GDP more on non-interest spending than we're raising in revenue. And then let's assume that the growth rate is 4 nominally and the interest rate is 3. In that case, your debt is going to keep rising until it gets to about 300% of GDP, right? 3 over 1, 300%. At that point, debt's not going to really grow anymore. It's going to asymptote to that 300%, meaning it's going to kind of level out, because once debt gets that high, you're going to be eroding your existing debt faster or as fast as you're adding new debt. Similar circumstance works if we pick sort of any combination of growth rates, interest rates, and primary deficits. If it's a 2% primary deficit, and again, that 1% gap, your debt will keep growing, but eventually it'll stabilize at about 200% of GDP. And by the way, one cool feature of this, and one that I think Olivia Blanchard and Larry Summers and others have used to justify one-time stimulus spending, is if you're in the scenario and you have big one-time borrowing, ultimately it'll erode. And over the very, very long term, it won't matter all that much. So let's take the same scenario, but let's assume we have sort of another set of COVID rescue-like deficits, 2 years of 10% of GDP deficits. That's going to add to the debt significantly when it first happens. But over time, we're going to basically end up in the same place. Now, this is 500 years in the future, mind you. But if you start to look at this graph, you see that over time, eventually that one-time borrowing, so long as it is not continued, won't meaningfully increase your long-term debt. So that's sort of, this is the argument that Olivia Blanchard and others have made for why our debt might be sustainable, even with high deficits. This was the argument they were making. In an era of low interest rates, your debt might be sustainable even with high deficits. But the truth is, R versus G is not, or I should say, it's neither necessary nor sufficient for debt sustainability. Because remember, I said all those variables have to be stable. And in the real world, rarely is anything stable. So if you want to have sustainable debt, you probably need, maybe not all of these things, in fact, not all of these things, but a decent number of the following things. You need to have manageable debt levels, modest and stable primary deficits, favorable demographics, limited healthcare cost growth, robust revenue collection, a responsible and responsive political system, and or R minus G, interest rates below the growth rate. Again, you don't need all of these things, but if I was looking at a country to ask the question, is their debt sustainable? I'd want to go through this checklist and see which one of these things do they have. So let's go ahead and do that for the United States. Let's start with manageable debt levels. Maybe not so much, right? So throughout our history, debt has averaged about half the size of the economy. We boosted it significantly during the Great Recession. We boosted it significantly again during the COVID recession, but we are just in an upward path from here. Our previous record set just after World War I was followed by 20 years of balanced budgets. And as you see in this graph, we went from 106% of GDP down basically to 40 or 50% within 2 decades, and ultimately down to 25% or so. That's not the circumstance here. The circumstance here is under official projections, debt is going to blow past that World War II record. It's going to hit it around 2029 and keep rising. We have debt that is very high, well above the 60% Maastricht Treaty level that we've kind of long been a convention, well above our 50% average. Not yet in unprecedented territory, but very close to that as well. And if you look going forward, these are just Congressional Budget Office projections. You'll see the trajectory is not good. So manageable debt levels, maybe not so much. What about modest and stable primary deficits? Again, we are not doing great. Prior to the pandemic, we were running trillion-dollar deficits. We borrowed a lot for 2 years for COVID. We can argue whether all of that money was well spent, but it certainly was understandable why we spent so much. And so we had 2 years of $3 trillion deficits. Last year, we were back down to $1 trillion, which, by the way, is an awful lot. But it turns out, excuse me, when I say last year, I mean 2 fiscal years ago now, in 2022, we were at $1 trillion, which seems like a lot, but turns out that was actually a good year. It was boosted by huge revenue intake from one-time capital gains and from big inflation, which boosts taxable income first, and then the tax code is indexed on a lag. Since then, deficits have doubled. Last year, the effective deficit was $2 trillion, which is 7.5% of GDP. That means primary deficits were, in the range of 5% of GDP. This is higher than any time in U.S. history, other than when we've been in a war or major recession. We do not have low or stable primary deficits. But what about the future? A country that has favorable demographics can count on strong growth, strong future revenue collection, as kind of a way to dig itself out. Unfortunately, that country is not us. We are getting older as a society. Our population is essentially no longer growing, or it's barely growing. But we are getting older, which means that we have an almost fixed number of workers for a rising number of retirees collecting Social Security and Medicare, and increasingly, going forward, a rising number of people in their 70s, 80s, and 90s who not only are collecting Social Security and Medicare, but very unlikely to be in the workforce in any significant numbers, very unlikely to be contributing to GDP growth, economic growth in any significant numbers. So demographics are working against us. They're making things more expensive. They're reducing our growth. They're reducing our revenue intake. And side note, but a really important one, they are pushing Social Security on a path towards insolvency. Medicare as well. Within 10 years, both of those programs' trust funds will have run out. That doesn't mean the programs disappear, but it does mean that the law requires a deep across-the-board cut or else substantial borrowing from the rest of government. That would require a new law. You can see here, Medicare is projected to run out in 2031, hospital insurance program, Social Security old age program in 2033. This is mainly, but not exclusively, driven by the demographics. I feel like, again, this is Halloween themed, so it's just going to get spookier. I'm not even going to pretend that maybe we have limited healthcare cost growth. The United States spends 50% more than the next largest country overall in healthcare. We spend twice as much as the average. We spend about average just on government healthcare, despite the fact that our government healthcare only covers senior and low income, and most countries, their government healthcare covers everyone. We spend a lot on healthcare. A lot of that's in the private sector, but a lot of it's in the public sector, where the cost of Medicare, Medicaid, and to a lesser extent, other programs like Obamacare subsidies are continuing to rise. By the way, if not for the aging of the population and rising healthcare cost growth, spending on our big 3 programs, our biggest 3 entitlement programs, Social Security, Medicare, and Medicaid, would actually shrink over the next 30 years. The reason for that is that we're still doing some COVID relief in Medicaid. Outside of that, they'd be roughly stable. But the rise in healthcare costs in excess of economic growth and the aging of population mean that they're going to grow from about 12% of GDP to about 16% of GDP. That's essentially as much as we're collecting in revenue today. Which brings me back to my next point. A country that had a large and expensive Social Security and healthcare regime could afford it if they were bringing in enough revenue. But we are not. We had one great revenue year in 2022. The last great revenue year we had before that, it was in the year 2000. But typically, we collect 17.5% of GDP in revenue, which is way below what we spend. And last year, I know we've heard some talk about record revenue. That was old talking points. Last year, we actually collected 16.5% of GDP. So our revenue declined substantially between 2022 and 2023. That's not mainly because 2023 was a bad year. It's because 2022 was a weirdly good year. And the steady state is more like last year, with revenue below 17% of the economy, below the historical average, and not growing all of that fast. Part of the reason it's not growing fast is that we spend an increasing share of our tax revenue each year effectively on tax breaks. Tax expenditures, we call them. But these tax breaks cost $1.7 trillion last year, which is as much as we spend on healthcare. In fact, a large share of them do go to healthcare on the tax side. We subsidize employer-provided healthcare insurance through the tax code, but they go through all sorts of stuff: mortgage interest, state and local taxes, getting to reset your capital gains at death, all sorts of things like that. Some of these tax expenditures are good policy or supporting good causes, but most of them are relatively inefficient, ineffective. Some of them create very big distortions, lead to bad investment, and certainly they deprive us of revenue. So too does our lack of tax compliance in this country. In 2021, it's estimated we lost about $625 billion from taxes that were owed but not paid. Of course, we're never going to get this to zero, but that is a tremendous share of our revenue, 15%, that is just never paid even after it's owed. I've heard a lot of people, Paul Krugman is a great example, say, okay, the long-term debt is a problem. I admit, healthcare costs are out of control, demographics aren't very favorable, we don't have enough revenue, and our debt is high, but we can always just fix it later, so don't worry about it. And in some countries, that's true. In some countries, they can change their budget very fast. And so as long as your interest rate's below your growth rate, if you just get that primary deficit down low enough, or you get into primary balance, you can change course. Unfortunately, our political system is not all that responsive and not all that responsible. Of the major pieces of legislation since over the last 25 years or so, I had someone on our team go through and show how much they cost or how much they save. The orange are the savers, the blue are the costers. You can see we're not great at deficit reduction. It's not that we never do it. We did it in 2011. We did it most recently with the Fiscal Responsibility Act this year. We've done it a couple of other times, but the vast majority of legislation Congress passes is to worsen the debt, not to help it. And the vast majority of that worsening the debt legislation actually happens on a bipartisan basis. There is no party here that is innocent of adding to the deficit. They've done it on all Democrats, all Republicans, but most often Democrats and Republicans together, cutting taxes, increasing spending, adding to the debt. And in fact, maybe we'll do another webinar on this, but going forward, the biggest fiscal moment we have coming up is an opportunity where they may add easily $4 trillion to the debt. At the end of 2025, large parts of the Tax Cuts and Jobs Act, along with several parts of the Affordable Care Act, expansions of our healthcare subsidies are scheduled to expire. Although some people maybe would be happy with them expiring, the majority of folks in both parties have talked about extending most of these provisions. And some of them have talked about even expanding these provisions, making the child tax credit or the standard deduction larger, weakening the limit on state and local taxes. So if you just did a straight extension, that's $4 trillion added to the debt. If we did sort of a modified extension for only people below $400,000, you're still probably adding $2 or $3 trillion to the debt. And if we do what I think the politicians maybe want to do, we could be talking about $5 trillion to the debt. So we do not have a political system, I think, right now that is ready to take on these challenges. And in fact, in both parties, we hear people just taking things off the table. Yes, I want to balance the budget, but we're not going to touch Social Security, defense, or Medicare, or veterans. If you do that, you got to cut the rest of spending by 75, 76%. That's obviously unrealistic. Similarly, yes, we want higher taxes, but nobody making less than $400,000 a year is going to pay less in taxes. Even less in tax compliance, right? So if you want to cheat on your taxes, just make sure you're only making $399,000. You cannot solve this problem by only looking at a small share of the budget or 2% of the population for taxes. It's just not going to work. And yet time and again, we hear our politicians saying they're not going to touch this or they're not going to touch that. Which brings me to my last point. Even with all of these bad things, in theory, we could have a sustainable debt if our interest rate is below the growth rate. But in reality, it's not all that clear. As I mentioned before, interest rate has been below the growth rate for the last 15 years. In fact, it's been below our growth rate for most of modern history. And when it was above our growth rate, basically in the 80s through mid 2000s, it wasn't very much above it, as you can see from this graph. But having your interest rate below your growth rate is not enough. First of all, if your primary deficits are still growing, your debt will grow forever, even with your interest rate below your growth rate, right? So here's an example. I have growth rate of 4%, interest rate of 3%, and I just assume the primary deficit increases by 0.01% annually. This is plausible if healthcare costs keep growing, politicians keep cutting taxes, and we continue to age. This could happen. Debt would grow forever in this circumstance. Clearly not sustainable. Also, just because something is mathematically true doesn't mean that it matters in the real world. It's possible that we have a circumstance where the interest rate, growth rate, and primary deficits means debt will stabilize, but it's not going to stabilize for like 1,000 years, right? Take this example. The 3% primary deficit with a growth rate 0.2% above the interest rate. In this case, debt will stabilize at about 14,000% of GDP and in about 2,000 years, right? That doesn't do us any good to know that like 2,000 years from now, right? The time from Jesus Christ to now over again, debt is going to eventually be stable. That's effectively the same as infinitely rising debt. On top of all of this, I think it's important to remember that interest rate and growth rate aren't stable and they're actually affected by the debt. Literature out there suggests that each percentage point of GDP you add to debt increases interest rates by 2 to 3 basis points, meaning every time you increase debt to GDP by 1%, the interest rate goes up 0.02 to 0.03%. That's not that much for 1%, but that adds up to a lot. On top of that, higher debt slows economic growth. And so the more debt you have, the higher your interest rates, the slower your economic growth. And so even if your R starts below G, high debt is going to boost your R, shrink your G, and eventually they may swap. We ran one example for this where we basically started by assuming stable primary deficits with R equaling G, and then we let some dynamic effects take over. Basically, we assumed, well, what if high debt pushes up interest rates and down growth? You can see for a while things look kind of the same. Through around 2050, they're similar, but over the long term, they start to hockey stick out of control. And then lastly, and I think here's the reason many of you all were interested in this webinar today, R is not below G anymore. The interest rate on new treasuries, most of them is between 5 and 5.5%. The 10-year, I haven't looked since the webinar started, but it's either at 4.8 or 4.9. The 3-month is at 5.6. They are on average well above 5%. Meanwhile, we think the growth rate going out is probably going to be like 3.5 to 4%. The Federal Reserve says 3.8, CBO says 3.7, the blue chips say 4.1. We don't know the exact growth rate, but it's nowhere near 5. Nobody thinks we're going to have a 5% growth rate unless we end up with very high inflation. And so on new debt, the interest rate is already above the growth rate. That's a problem. This is sort of a illustrative case, but if you imagine that the interest rate is a point above the growth rate with 2.5% of GDP flat deficits, debt is growing forever. Debt is unsustainable. And then if you add in this dynamic feedback, you assume that these higher debt means higher interest rates, means higher debt, means slower growth. Debt starts to really hockey stick in the 2050s and 2060s. At some point, it goes from being ultimately unsustainable to being sort of in this debt spiral crisis moment. I'm not saying this is where we will be. This is an illustrative case of where we could be if our interest rates stay high and if our debt continues to grow. Now, maybe interest rates will come back down. I think there are some reasons for optimism. Certainly, near-term rates are likely to come down. The Fed isn't going to keep its rate high forever. And when it cuts its rate, at least near-term rates are coming down. As population gets older, that means more savers. That should put downward pressure on rates. Same with rising global wealth. And lastly, to the extent that these high rates reflect rising productivity growth, we may actually be getting higher G. And so even if our R is higher, if our G is higher too, we're okay. But I think there's also some good reasons for pessimism. Things could get even worse. With inflation and employment remaining both relatively strong, the Fed may take a lot longer than people anticipate to start cutting rates. While yes, older people save more, aging within the old actually reduces savings because the oldest Americans are withdrawing from their savings. They're spending more, saving less. Also, rising global income means there's going to be more spenders around the world. They're not going to want to buy US Treasury bonds. They're going to want to buy stuff. And then lastly, as I think I mentioned a few times, as our debt rises, our interest rates are likely to rise too in slow growth. So net, do I know if interest rates are going to rise or fall over the next few years? I don't. If I had to guess, they're going to peak at some point in the next year. They're going to decline some, and then they're going to be back on an upward path. But my guess is about as good as the financial markets at predicting it, which is to say, not good at all. We just don't know. What we do know is that there's no guarantee that interest rates will be below the growth rate. And in fact, they are already above the growth rate. I think people, when they were, took advantage and made some silly choices. There was a lot of talk that when interest rates were low, borrowing was free. You know, it was never free, but there's a lot of people that felt like it was free, borrow as much as you want. And so 70 to 80% of the debt we have today was borrowed when interest rates were below 4%, 60 to 75 when they were below 3%. A substantial amount of the debt we issued was when interest rates were below inflation. But guess what? Debt rolls over. The debt that we originally issued in low interest rates is increasingly being reissued at higher interest rates. And soon, if things don't turn around, we are going to be in trouble. I have a bit more of my presentation, but I would like to take a pause for some questions because I see that there's a lot of them. And then if there's still time at the end, we can do the last stuff.
Thank you so much, Mark. First, let me just start off by saying, before we get into the questions, that there is a lot of interest in getting the slides after this webinar. So we will be posting both a video of the webinar along with the slides on our website, crfb.org, and we will also be sending it out to all those who RSVP'd. Before getting into some of the meatier questions, let's begin with a quick clarifying question from Brett. Can you confirm that G in this presentation is nominal growth and not real growth?
That's a great question. So when you're comparing R versus G, you either need to compare them both nominally or both in real terms. It honestly doesn't matter which. For purposes of my presentation, I'm looking at nominal in both cases. But if you look at both of them on a real basis, as long as you're adjusting by the same rate of inflation, you would get to the same answer.
Great. So we have a question from Scott at BRT that gets into some of the details. Do you have any views on the discussion about if Treasury should have issued debt at the longer end of the curve rather than bills and notes when rates were so low for the last few years? Could that have lengthened average maturity?
Yeah, so I think there's a few things to understand about what Treasury does when it's issuing debt. One of Treasury's goals when they're issuing debt is to try to minimize the cost to the U.S. taxpayer. And it's not as simple as looking at which interest rate is lower or higher, because you're also trying to predict the future and predict the rollover. Another of Treasury's goals is to provide stability to the markets, predictability to the markets, and sometimes even liquidity to the market. So Treasury had many goals. And at the beginning of COVID, even though interest rates in the 10-year bonds actually fell below 1%, I think even below 0.5% for a few days, it's not clear to me that there was really the market for them that it seemed. The Federal Reserve on average was buying more than all of our debt. Treasury did send us some surveys to see if people were interested in 50-year bonds, and they just weren't. So this is all to say, like, I don't think we should be too hard on Treasury because things weren't as obvious they look in hindsight. With that being said, clearly we'd be in a better position now had we issued more longer-term debt, especially when the 10-year Treasuries were at 1% to 2% versus now at 5%, especially when the 30-year Treasuries were at 1% to 2%. As opposed to now above 5%, that would have helped. In some ways, that's a kick the can, because eventually that debt will roll over, right? There's no infinity bonds. So eventually it will roll over, but that could be a helpful kick the can while you're reorganizing the rest of your fiscal situation. And so, yes, I think that we should have issued more long-term debt. And if we had, we'd be dealing with less rollover risk right now.
Mark, Nathan would like to know if you could talk more about why GDP growth is the metric you were comparing interest rates to.
Yeah, so the reason is that the most common measure of debt sustainability we focus on is debt to GDP, right? And so if you're focused on debt to GDP, growth tells you how much you're eroding your debt to GDP, and interest rates tells you how much you're expanding your debt to GDP. And that's why I focused on that. There's an argument that instead of GDP, you should use, let's say, a different measure like revenue base or even GNP or net domestic product. There are different measures you could use. It's not, I would say GDP is the convention, but it's not obviously the best. But all of those measures would get you to the same theoretical place and almost to the same mathematical place. They wouldn't differ by a substantial degree.
Mark, I think this one you'll have no problem answering. John from North Carolina wants to know, if the US found the political will to adopt Bold-Simpson today, how would it help? How much did ignoring it hurt? And are we way past those type of remedies in our current environment?
So I'm biased here. I worked on Bold-Simpson. I helped get 11 out of 18 members that ranged from far right to far left to support this package that at the time would have put debt in a downward path. And I think probably would have created the kind of responsible mentality that would have avoided some of the future deficit increases we passed, like the Tax Cuts and Jobs Act, and like the bipartisan budget acts of 2018 and 2019, among others. So you've got to account for both the direct effects of Simpson-Bowles and the indirect effects in creating a culture of responsibility versus a culture of irresponsibility. It would have made a huge difference. Simpson-Bowles probably, in hindsight, proposed its savings a bit earlier than was optimal for economic growth. Not as early as people criticized. We said nothing should start till 2013 or 2014, but a bit earlier. But I think what we're now seeing is, had we borrowed less in those times, we wouldn't be rolling over into high debt now. And we could have adjusted it to phase in a little more slowly based on the economy. Overall, it would have made a substantial difference in putting our debt in a more sustainable path, because it not only had $4 trillion of 10-year savings, but it had the kind of savings that really grow over time, both on the revenue side and on the healthcare side, and with 75-year solvency for Social Security. The last part I'll say is it too late? Partially, yes. A Simpson-Bowles type plan today would not be enough to fix our debt. Of course, it would be a tremendous improvement in the right direction. And so up or down vote on it, I'm in. But we actually need even more. Last year, CRFB put out a $7 trillion plan to stabilize the debt. That included even more aggressive changes than was in Simpson-Bowles. That's the kind of thing you would need now in order to get us on a sustainable path.
Great. We had a couple of questions that kind of get at inflation and their effect on interest rates in different ways. One from Mike here in DC. Are higher interest rates the result of higher inflation? And if so, won't nominal growth also be faster?
Yeah, this is a great question. So when I say our interest rates are above our economic growth rate, I'm essentially assuming inflation gets back to the 2% target as affected. It's possible that some of the increases in interest rates is because people expect higher inflation. And if that's the case, even though the economy won't really grow faster, the nominal economy will grow faster, we have more room. The issue here, and the reason I don't think this is a major contributor, is that when you look at how people trade inflation index bonds, you can kind of tease out their expectations, and you can see at least that on average, traders are expecting those interest rates, assuming a 2% inflation rate going forward. And what that means is that if inflation expectations really start to anchor upwards, I would expect further increases in the nominal interest rate. That may help us a bit for today's debt, but it's going to be a big trouble for tomorrow's debt.
Also on inflation, Buck wants to know, does inflation allow the debtor to repay the debt with cheaper dollars where we currently stand?
You know, inflation is a good way to erode your past debt. But with the United States, most of our debt is based on future obligations. And so big inflation, you know, it reduced our debt to GDP ratio basically from 100% to 96%. But now we're right back at 100 already from the higher interest rates. And so, you know, inflation by itself is not a way out when you're borrowing $2 trillion a year going forward.
Thank you. Donna down in Florida wants to know, won't all this go away when the Fed cuts rates?
So when the Fed cuts rates, if in fact inflation is under control, it's going to help reduce especially near-term interest rates that we're borrowing. I want to say if the Fed cuts rates too early, it may actually make things worse because of the inflation expectations issue. But if they cut at the appropriate time, it may help in the near term. And the numbers we put out do assume that it's going to help in the near term. But those long-term rates, while they may be somewhat related to the Fed, really do have a life of their own. And I expect to return to the old way, where there's a term premium where the long-term rates are higher than the short-term rather than the reverse. And so I wouldn't expect, you never know, but if the Fed cuts rates by 3%, I'd expect the 3-month bond to go down 3% and the 10-month maybe to go down 1%, if that.
Great. Well, talking about the Fed and borrowing, Susan wants to know, who do we borrow money from? And do we borrow a significant amount from China? And if so, why?
Yeah, so our new borrowing is from ourselves. From ourselves, I mean from US citizens, from US banks, from US pension funds, etc. Almost all of our new borrowing is being funded domestically. Our foreign borrowing, while we do owe a lot to foreign governments and to foreign individuals, it's essentially been flat for the last 8 years. The Federal Reserve, which owns a lot of our debt, is actually unwinding. And so more than all of our net borrowing is from Americans, mainly in the US financial institution, which means you're going to see more what we call crowd out, more reductions in US investment, because we're taking capital that could be used for productive purposes and using it to, you know, fund higher Medicare payments, essentially. And it also means there's more vulnerability in the US financial system. Now, Japan and China are the two largest owners in that order of our debt on a foreign basis. China's been shrinking their balances of our debt. Japan has stopped growing it. That puts us in a precarious position, even with that shrinking position.
Great, thank you. Drew from Minnesota has a quick question about how you define the federal budget. Are programs like Social Security and the US Postal Service included, or are those separate non-budget items?
Yeah, so in all of these measures, I'm looking at debt held by the public. And so effectively, Social Security and the Postal Service are in the mix. If we looked at gross federal debt, which kind of removes them, although it's more complicated, what you would see is a debt ratio that's much higher, but growing a bit slower. The fundamental story wouldn't change, although it would be less economically meaningful because, frankly, China doesn't care that, you know, the Treasury Department owes the Social Security Administration money.
Great. The next question is from Reynold, who asks if you could give a quick overview of what are some of the major policies that could help improve our growth, the G, without changing spending levels or taxes, and the potential size of the impact of those changes in policy.
Well, I think the best policies we can look at to answer not quite the question you answered is the policies that can improve our growth while also reducing our primary deficit and reducing our interest rate, right? Because if debt sustainability is a combination of RG and your primary deficit, you want policies that push those all in the right direction. And those exist. The biggest example I will give, because we wrote a whole paper on this, I recommend, is within Social Security reform. If we make changes to the Social Security program that focus benefits on those that are less able to save on their own, and that gradually adjust the retirement age for those that can afford to work longer, and that improves the signals that people have of how much to work, there's the potential to substantially increase U.S. growth potential by increasing savings and investment and labor, to reduce interest rates by lowering deficits, and to reduce the burden that the Social Security program would otherwise have through its insolvency on the rest of government. And so I would say, first and foremost, the smartest thing we can do is probably to make Social Security solvent. That's going to reduce our deficits, increase our growth, and lower interest rates. The next smartest thing we can do is to lower healthcare costs, because that has the potential to increase savings in the overall economy, reduce the pressure on households, again, lower primary deficits and interest rates. And the third smartest thing we can do is to cut some of the distortionary tax breaks in the code that cause businesses and individuals to make really bad investment choices and add to our rising debt.
So we have a question that I think will resonate with a lot of people on this call, because I think everybody who's logged in today cares about the economic sustainability of the country. Henry wants to know, what questions should we be asking our elected officials about how we can drive the direction of the country in a more sustainable way?
That's a great question. So I'm going to go back to my slide deck for a second, because I just want to skip to one very important point that's not about RG, but I think is very telling as we consider the effects of higher interest rates. This is from a forthcoming analysis. We haven't done it yet. We're waiting for the interest rate to hit 5, which I assume it will relatively soon. Under CBO's latest projections, interest spending is going to exceed defense spending by 2026 or 2027. Interest spending last year was larger than everything the federal government spent on children. Everything. Child tax credit, K-12 education, school lunches, child healthcare, you name it. We spent more in interest in servicing the past than investing in the future. If interest rates are as much higher as they are now, that situation goes from bad to almost unconscionable. This is estimates of what happens if the interest rate is 1.1% higher than CBO has projected, which is essentially where they are now. If that continues to be the case, in 2 years, fiscal year 2026, interest will be the second largest government program. It will blow past defense next year. It will exceed Medicare the year after that to be the second largest government program. I would ask your politician, why are you okay with that? Why are you okay spending more on interest than on protecting the country? Why are you okay spending more on interest than keeping people out of poverty? Why are you okay spending more on interest than making sure our taxes are reasonable? You name the thing. Every dollar spent on interest is a dollar you can't contribute to it. And politicians need to sort of stand up and say, I'm not okay with this. I'm going to make a change. I'm going to make sure Social Security is solvent so it doesn't run out of money. I'm going to make sure the debt is sustainable so that interest doesn't eat everything else alive. And just to cheat to another chart, so I don't erode income growth for American households who, under a rising debt scenario, will see their income growth shrink by 1/3. That's the imperative for any stewards of this economy.
Mark, Pierre would like to know, what can we do to increase government revenues that will decrease deficits over time?
My preference when looking at revenues is to start by making the tax code more efficient. We have so many tax breaks that make investment decisions worse, that make the tax code more complex, that distort behavior, and that add to the debt. We still let people take $10,000 of state and local taxes, and we let them cheat by creating companies to essentially creating small businesses to avoid the existing cap. The mortgage interest deduction drives up home prices. This is the last thing we need right now. The employer health exclusion makes healthcare more expensive. The single, the thing that's the most costly in our economy is driven by the tax code. The stepped up basis of capital gains creates wealth hoarding. It stops people from wanting to sell their assets. It doesn't matter whether you think the right capital gains rate should be 10% or 50%. There's no reason it should drop off to 0% if you happen to sell the day after you die versus the day before you die. So I would start by getting rid of a lot of these distorting tax breaks in the code, and we can raise a ton of revenue that way. If that's too hard for the politicians, I think we can look at things like carbon taxes. We can look at raising ordinary rates. The corporate rate is 21%. It used to be 35. I think at 25 we'd still be competitive. So there's lots of options, but we should focus where possible on getting the most economic growth and the most efficient tax code. And I think that means cutting a lot of these tax breaks.
Great. I'm going to give you two more quicker questions that kind of challenge the thesis a little bit before doing one final one that's a little bit longer form. Joshua wants to know, is R really greater than G right now with real growth running close to 2% and inflation above 3%? Doesn't that mean G is actually above 5%?
Great question. So when you're looking at whether R is versus G, you need to compare the interest rate on the bond to the expected growth rate over its term, right? So if I'm looking at a 10-year bond at 4.9%, what I want to know is how that compares to the expected growth rate over the next 10 years. And that expected growth rate is closer to 2%, probably, closer to 4%, probably below it. If I'm looking at the 3-month bond, which is at 5.6%, that may indeed be about in line with the expected growth rate. It's certainly not way below it, but it may be about in line with the expected growth rate if we think we're going to have 2% and 3%. But anything that kind of terms out more than 2 years, it's pretty indisputable. And to the extent that this is driven by people being wrong about inflation, that's kind of already clear in the trading, and we would see interest rates rise even further.
And then from Albert, if we interpret R as the after-tax interest rate, does that make a difference in your story?
This is a great question, too. You do want to consider, for simplicity, I just said average tax rate, average interest rate. We usually measure that by looking at net debt service payments, net interest payments. The truth is, you probably have a much more complicated thing you'd want to do. You probably want to take net interest payments. You want to remove student loan repayments and business loan repayments that aren't really part of the equation. You want to account for the taxation of the interest rate, taxation of returns. And the other thing you want to do is account for the share of the Federal Reserve remittances, Federal Reserve paying the government, that's related to these higher and lower interest rates. And you could make all of these adjustments. And on net, they'd probably make the story a little bit worse, not a little bit better, but they wouldn't change the fundamental narrative.
Great. So now I'm going to say this is our last question as we're coming up kind of on the end of the allotted time, but a couple of people asked this in different ways. So I'm going to try to sum it up as succinctly as possible. Basically, do you think that rising interest rates will get Congress to finally focus on this issue and take action? This might be the hardest one to answer.
I sure hope so. So look, in the 1990s, it really was the high interest rates that convinced President Clinton to kind of continue down the path that President Bush had started on deficit reduction and ultimately led us to the balanced budget. Unfortunately, I think the political system is more calcified now. I think it's more divisive. I think it's harder. And so interest rates alone may not be enough. But we can imagine a 1-2 punch still, I think, where interest rates are helpful. For example, when the Medicare trust fund is projected to run out, in theory, Congress could just paper that over with more borrowing, right? But the combination of that trust fund crisis and knowing that more borrowing is very expensive from high interest rates, that might be enough. Or as another example, if we establish a fiscal commission, I sure hope we do, the interest rate may be the thing that nudges them to get to agreement, that gets people that are a little bit on the sidelines ready to say, you know what, I think this is worth it. And so I'm pessimistic that interest rates alone can do this, even though it should be enough. But I think that the interest rates, along with a second spark, may be what it takes to get our politicians to wake up and understand just how much malpractice they are doing to our economy.
Great. Marc, thank you so much for taking the time to do this. I will close out by saying we got a comment, not so much a question, from somebody who said this was very interesting, informative, and downright scary for our future as a country. And I think that is a really good way to sum all of this up. And thank you to everybody who logged in. One last reminder, we will be sending out the slides as well as a video of this presentation to everyone who RSVP'd. And please feel free to email info@crfb.org if you have any other questions that were not addressed on this webinar. Thank you so much, and we hope to see you again at another event in the near future.
Thank you.